Welcome to this comprehensive discussion on the Foreign Trade Policy 2023, an extremely important topic for CA Final IDT, as well as for understanding how India's international trade framework operates. In this session, we will explore the legislative foundation of the foreign trade policy, the role of the DGFT, classification of goods, WTO compliance requirements, export promotion schemes, administrative authorities, and the interaction between FTP and indirect tax laws. Rather than memorizing isolated provisions, our focus will be on understanding the logic behind the policy so that concepts become easier to retain, revise, and apply in examinations as well as practical situations. Let's begin by understanding why foreign trade policy exists in the first place. Foreign trade policy, commonly known as FTP, is one of the most important frameworks governing India's international trade activities. In today's globalized world, no country can grow in isolation. Nations specialize in producing goods efficiently, exchange them across borders, and expand their market reach globally. FTP provides the guidelines issued by the central government regarding imports and exports. Its objective is much broader than merely earning foreign exchange. It aims to develop export potential, improve export performance, encourage foreign trade participation, strengthen industrial competitiveness, and create a favorable balance of payments. In simple words, FTP acts as a roadmap that helps India integrate effectively with the global economy while promoting export-led growth. To regulate and promote foreign trade, India relies on a strong legislative framework. The foundation is the Foreign Trade, Development and Regulation Act, 1992, commonly called the FTDR Act. This law empowers the government to facilitate imports and augment exports from India. The Ministry of Commerce and Industry is the primary authority responsible for managing foreign trade affairs. Under this framework, the current Foreign Trade Policy 2023 became effective from the 1st of April 2023 and continues until modified or amended. Interestingly, what was once known as the SION policy is now called the Foreign Trade Policy because its scope extends beyond mere exports and imports, covering broader aspects of international trade and economic development. The FTDR Act grants extensive powers to the central government for regulating foreign trade. The government can make provisions to facilitate as well as control international trade whenever required. It may prohibit, restrict, or regulate imports and exports in the public interest. These policies are formally announced and amended through notifications published in the Official Gazette. Another crucial power is the appointment of the Director General of Foreign Trade, or DGFT, who is entrusted with implementing and administering the policy. Think of the government as the policymaker and the DGFT as the operational authority responsible for converting those policy objectives into practical implementation across the country. A fundamental principle of the foreign trade policy is that imports and exports are generally free unless specifically regulated. Based on this principle, goods are classified into three categories. First are free goods, which can normally be traded without any special authorization, although some may require routing through state trading enterprises. Second are restricted goods, where import or export is permitted only after obtaining a license or permission from the government, usually for strategic, health, defense, or environmental reasons. Finally, there are prohibited goods, which are completely banned from import or export. This classification helps the government balance trade freedom with national security and public interest consideration. An important principle behind India's export promotion strategy is the concept of tax neutrality. The philosophy is simple: export goods, not taxes. Since India is a member of the World Trade Organization, it must comply with WTO principles such as non-discrimination, fair competition, and predictable market access. The WTO discourages direct export subsidies that distort competition. Therefore, Indian export schemes are designed not as incentives, but as mechanisms to remove domestic tax burdens from exported goods and services. This objective is achieved through schemes such as EPCG, EOU, and SEZ benefits, and deemed exports. The ultimate goal is to ensure that Indian exports remain globally competitive without violating international trade rules. The Director General of Foreign Trade, or DGFT, plays a central role in administering the foreign trade policy. Functioning under the Ministry of Commerce and Industry, the DGFT formulates, supervises, and implements various provisions of the FTP through its headquarters and regional offices. One of its major responsibilities is issuing authorizations, which permit the import or export of restricted goods. The DGFT also grants the Importer-Exporter Code, commonly called the IEC. Except for specified exemptions, no person can undertake import or export activities without obtaining an IEC. Additionally, the DGFT's interpretation of the FTP, Handbook of Procedures, and ITCHS classification is considered final and binding. Given the complexity of international trade regulations, several specialized committees assist the DGFT in decision-making. The Policy Interpretation Committee, or PIC, advises on interpretation issues arising under the policy. The Norms Committee is responsible for fixing and modifying product norms under various schemes. The EPCG Committee examines matters relating to capital goods and benefits available under the Export Promotion Capital Goods Scheme. All other issues requiring relaxation or special consideration are handled by the Policy Relaxation Committee, or PRC. Together, these committees ensure consistency, transparency, and expert evaluation while implementing various provisions of the foreign trade policy. The foreign trade policy incorporates mechanisms to address genuine hardships and disputes faced by traders. In the public interest, the DGFT may grant exemptions, relaxations, or relief after consulting the relevant committee. If an importer or exporter is dissatisfied with the decision of the PRC or another DGFT authority, they can request a personal hearing before the DGFT. After considering the matter and consulting the appropriate committee, the DGFT may provide suitable relief, and the resulting decision becomes final and binding. Additionally, the Settlement Commission established under the Department of Revenue offers taxpayers a one-time opportunity to resolve export obligation defaults and customs disputes efficiently. While the DGFT is the principal authority administering the foreign trade policy, successful implementation requires close coordination with several other government agencies. The CBIC, through its Customs Department, handles valuation, examination, and clearance of imported and exported goods, while GST authorities manage tax-related export procedures. The Reserve Bank of India plays a crucial role in regulating foreign exchange transactions and monitoring export-import payments. State GST authorities supervise taxpayers assigned to their jurisdiction, ensuring efficient tax administration without overlapping control. Together, DGFT, CBIC, RBI, and state GST authorities function as an integrated ecosystem, ensuring that India's foreign trade operations run smoothly from policy formulation. Now that we understand the authorities involved, let's examine the structure of the foreign trade policy framework itself. The framework consists of three major pillars. First is the Foreign Trade Policy 2023, which lays down the fundamental policy principles across 11 chapters. Second is the Handbook of Procedures, commonly known as HBP, which provides detailed procedural guidance and includes appendices, ayat-niryat forms, and standard input-output norms. The third pillar is the ITCHS classification system, which classifies goods using India's 8-digit coding structure. Together, these three components create a comprehensive framework that governs both policy formulation and practical implementation of foreign trade activities. One important concept within the foreign trade framework is the Standard Input-Output Norms, commonly known as SION. These norms specify the exact quantity and value of inputs that may be used to manufacture a particular export product, along with the expected output quantity. In simple terms, SION determines how much raw material is reasonably required to produce a specified export item. These norms are extremely important because duty exemption schemes such as Advance Authorization and DFIA rely upon them. By establishing standard consumption norms, SION ensures that exporters receive duty-free import benefits only for inputs genuinely required in the manufacturing process, preventing misuse while encouraging exports. A common misconception among students is that provisions of the foreign trade policy automatically override tax laws. However, that is not the case. While FTP and indirect tax laws work closely together, tax statutes such as the Customs Act and GST laws continue to have overriding legal authority. Any exemption announced under the FTP becomes effective only when a corresponding notification is issued under the relevant tax law. In practice, exporters and importers derive their actual benefits from exemption notifications issued by CBIC. At the same time, tax authorities cannot challenge decisions relating to authorizations granted by Commerce Ministry authorities, ensuring clear jurisdictional boundaries between policy administration and tax enforcement. The relationship between FTP and indirect tax laws goes even deeper. Rather than operating independently, these laws form a unified and integrated taxation framework. The Foreign Trade Policy, Handbook of Procedures, Customs Act, CGST, SGST, IGST laws, and even the Central Excise Act for specific products must all be interpreted together. Understanding one law in isolation may lead to incorrect conclusions because each statute supports and complements the others. A special point to remember is that Special Economic Zones, or SEZs, although closely linked with foreign trade promotion, are governed under a separate dedicated legislation and technically do not form part of the foreign trade policy itself. Let's conclude by revising the key principles of the Foreign Trade Policy 2023. The entire framework is built upon the Foreign Trade Development and Regulation Act, 1992, and is administered primarily by the DGFT. The guiding philosophy is simple yet powerful: export goods, not taxes, ensuring WTO-compliant export promotion. Effective implementation depends on coordination among DGFT, CBIC, RBI, and state GST authorities. Another crucial principle is that FTP benefits become operational only through notifications issued under the respective tax laws. Finally, remember that FTP, HBP, customs laws, and GST laws together form an integrated framework designed to facilitate trade, promote exports, and strengthen India's participation in the global economy. Welcome to Part 3 and Part 4 of the Foreign Trade Policy 2023. In this session, we move beyond the basic framework and explore the practical mechanisms that make international trade faster, simpler, and more efficient. We will understand trade facilitation initiatives, stakeholder consultations, authorized economic operator status, status holder recognition, district export hubs, SCOMET regulations, and the key compliance requirements governing imports and exports. These concepts are highly relevant not only from a CA final examination perspective, but also for understanding how India balances export promotion, ease of doing business, and national security objectives. Let's begin with India's commitment towards global trade facilitation. India's trade facilitation efforts are strongly influenced by the World Trade Organization's Trade Facilitation Agreement, commonly known as the TFA. By ratifying this agreement, India committed itself to making international trade more transparent, efficient, and predictable. As part of this transformation, the DGFT increasingly acts not as a regulator, but as a facilitator of trade. It works closely with export promotion councils and industry bodies to remove procedural bottlenecks and improve the trading environment. Supporting this effort is the National Committee on Trade Facilitation, or NCTF, which coordinates the implementation of TFA provisions across different government departments and agencies involved in international trade. To translate trade facilitation goals into practical outcomes, India introduced the National Trade Facilitation Action Plan. The objective is not merely increasing exports but making trade processes simpler and faster. The plan seeks to improve ease of doing business by reducing transaction costs and procedural delays. It focuses on reducing cargo release time, creating a paperless regulatory environment, establishing transparency and predictability in legal procedures, and improving infrastructure that supports international trade. In essence, the action plan aims to ensure that exporters and importers spend less time dealing with paperwork and more time focusing on business growth and global competitiveness. A major pillar of trade facilitation is digital transformation. To create a contactless and paperless environment, the DGFT has launched several technology-driven initiatives. One important initiative is the Niryat Bandhu scheme, which mentors new exporters through training programs, counseling sessions, and outreach activities. Another significant development is the DGFT online portal, which provides facilities such as ERCMC registration, electronic certificates of origin, and mechanisms for handling quality complaints and trade disputes. Supported by a 24/7 help desk, these initiatives improve transparency, reduce human interface, and make it easier for exporters to access benefits available under various export promotion schemes. Trade facilitation is not limited to the DGFT alone. The Customs Department has introduced several reforms aimed at accelerating cargo movement and reducing compliance burdens. 24-hour customs clearance is available at designated ports and airports, ensuring faster processing. The SWIFT platform enables traders to submit clearance documents through a single online interface. eSansheet promotes paperless documentation and digital storage of records. Tarrant Customs introduces faceless assessment, reducing physical interaction and improving efficiency. Additionally, the Compliance Information Portal provides comprehensive information regarding duties, procedures, fees, and regulatory requirements. Together, these measures significantly improve India's trade ecosystem and support ease. The foreign trade policy recognizes the importance of industry participation in policymaking. Therefore, before formulating or amending the policy, the central government may seek suggestions, comments, and feedback from stakeholders such as exporters, importers, trade associations, and industry experts. Wherever feasible, stakeholders are generally provided a period of 30 days to submit their views. However, it is important to remember that this consultation mechanism does not restrict governmental authority. The central government retains complete power to formulate, amend, or introduce policy provisions on its own initiative whenever circumstances demand immediate action or policy intervention in the larger public interest. Although stakeholder participation is encouraged, the government is not always required to explain why particular suggestions have been rejected. Reasons may be withheld if disclosure could adversely affect trade relations with foreign countries, compromise national, economic, or food security, conflict with strategic government policies, reveal confidential information, or promote narrow private interests contrary to public welfare. Most importantly, stakeholders do not possess any legal right to demand explanations regarding the rejection of their views. This provision balances transparency with the need to protect sensitive national interests and maintain flexibility in policy formulation. The Authorized Economic Operator Program represents a trust-based partnership between customs authorities and businesses engaged in international trade. An entity that complies with prescribed supply chain security standards may be granted AEO status and recognized as a trusted trade partner. The program is based on the World Customs Organization's SAFE framework of standards. In return for maintaining high compliance standards, AEO holders enjoy significant benefits such as reduced examinations, faster customs clearances, deferred duty payments, direct port delivery, self-certification privileges, and enhanced facilitation in countries having mutual recognition agreements with India. This creates a win-win situation for both businesses and customs administration. The foreign trade policy also promotes export growth at the local level. Towns that make significant contributions to exports may be recognized as towns of export excellence and receive focused infrastructure support to enhance their competitiveness. Alongside this initiative, the government is developing districts as export hubs by identifying products and services with export potential in every district. District export promotion committees and district export action plans play a crucial role in identifying priority sectors and resolving bottlenecks. These initiatives support the objectives of Atmanirbhar Bharat and Make in India, while encouraging balanced regional economic development. To recognize exceptional export performance, the foreign trade policy grants status holder recognition to eligible exporters. Depending on export earnings measured in FOB value terms, exporters may be classified as 1-star, 2-star, 3-star, 4-star, or 5-star export houses. The threshold ranges from $3 million for 1-star status to $800 million for 5-star status. This recognition is not merely honorary. It reflects a trader's contribution to India's foreign trade and unlocks several operational benefits. Status holders are also expected to contribute to the development of future exporters through mentorship and training initiatives. While calculating export performance for status holder recognition, several specific rules must be followed. Export performance is evaluated based on the current financial year and the preceding 3 financial years. Exports under authorizations, including SCOMET exports, are included in the calculation, whereas re-export transactions are excluded. An important concession exists for 1-star export house recognition, where double weightage may be granted to specific categories such as MSMEs, ISO or BIS certified units, units located in specified regions, and exporters of fruits and vegetables. However, this double weightage benefit is strictly restricted to 1-star status calculations and does not extend to higher categories. Status holders enjoy several privileges intended to simplify business operations and reward consistent export performance. These include customs clearances based on self-declaration, priority fixation of standard input-output norms, exemption from furnishing bank guarantees under specified FTP schemes, and the ability of 2-star and higher export houses to establish export warehouses. Manufacturer exporters holding 3-star, 4-star, or 5-star status may also self-certify the Indian origin of goods for preferential trade benefits. Additionally, they receive priority treatment from various government agencies. In return, higher status holders are expected to mentor and train future entrepreneurs engaged in international trade. The foreign trade policy not only promotes trade, but also safeguards national and international security. This objective is achieved through SCOMET regulations, which govern special chemicals, organisms, materials, equipment, and technologies. These are dual-use items that may have legitimate civilian applications, but can also be used in weapons-related activities. Therefore, their export is either prohibited or permitted only through authorization. At the same time, trade disputes and quality-related grievances are handled by the Committee on Quality Complaints and Trade Disputes, known as CQCTD. This committee investigates issues such as non-supply, delayed delivery, and payment disputes between Indian and foreign parties. Before undertaking any import or export transaction, traders must verify the ITCHS classification of the goods involved. Goods may be categorized as free, restricted, prohibited, or subject to trading through state trading enterprises. Restricted goods require authorization from the DGFT, generally obtained through the DGFT portal using the Import-Export Code. Another important principle is the actual user condition, under which imported goods are meant for use by the authorized importer unless specifically relaxed by the DGFT. Furthermore, imported goods must comply not only with FTP provisions, but also with all applicable domestic laws, ensuring regulatory consistency and consumer protection. As we conclude, remember that the foreign trade policy is much more than a regulatory framework. It is a strategic tool for promoting exports, facilitating trade, enhancing competitiveness, and protecting national interests. Through digital initiatives, trade facilitation measures, AEO programs, status holder incentives, district export hubs, and SCOMET controls, India seeks to balance economic growth with compliance and security. For examination purposes, focus particularly on trade facilitation initiatives, status holder privileges, export performance rules, AEO benefits, and SCOMET regulations. Mastering these concepts will help you understand both the practical and legal dimensions of India's foreign trade framework. Best wishes for your CA final preparation. Welcome to Part 5 and Part 6 of the Foreign Trade Policy. In this session, we move into the practical compliance framework governing imports and exports. We will understand the ITCHS classification system, importer-exporter code requirements, mandatory trade documentation, penalties for non-compliance, import policies for special categories of goods, quality control orders, merchanting trade, export procedures, and realization of export proceeds. These provisions are frequently tested in examinations because they directly affect how international trade is conducted in practice. Let us begin with the classification framework that forms the foundation of all import and export decisions under the foreign trade policy. Every import or export transaction begins with classification. India uses an 8-digit ITCHS code based on the International Harmonized System to identify goods and determine their import or export status. It is important to distinguish between two schedules. The ITCHS schedule tells us whether a product is free, restricted, prohibited, or subject to special conditions, whereas the customs tariff determines the applicable customs duty. The policy also identifies certain goods that can only be traded through state trading enterprises such as FCI, ONGC, NAFED, and NDDB. However, the DGFT retains discretion to authorize private entities to undertake such transactions in appropriate cases. The Importer-Exporter Code, commonly known as IEC, is the passport for international trade. Except for specified exemptions, no person can legally undertake imports or exports without obtaining an IEC from the DGFT. The code consists of 10 alphanumeric characters and is linked to the applicant's PAN. A particularly important compliance requirement introduced under the FTP is mandatory annual updation of IEC details. Even if there are absolutely no changes in business particulars, the IEC holder must electronically confirm and update the information every year. Failure to comply results in deactivation of the IEC, effectively preventing the business from conducting international trade until compliance is restored. Proper documentation is the backbone of every export transaction. The FTP prescribes 3 essential documents that exporters must maintain. The first is the transport document, which may be a bill of lading, airway bill, railway receipt, lorry receipt, or postal receipt, depending on the mode of transport. The second is the commercial invoice cum packing list, which records both commercial and logistical details of the shipment. The third is the customs declaration document, usually the shipping bill or bill of export. Together, these documents establish ownership, movement, valuation, and customs compliance, enabling smooth processing and clearance of export consignments. Just as exports require specific documentation, imports also follow a structured documentation framework. Importers must furnish 3 key documents for customs clearance. The first is the transport document proving carriage of goods into India. The second is the commercial invoice cum packing list issued by the foreign supplier, detailing the value and contents of the shipment. The third and most important customs document is the bill of entry, which serves as the formal declaration filed before Indian customs. Depending on the nature of the imported goods, additional regulatory documents may also be required. Proper documentation ensures accurate assessment of duties and compliance with all import regulations. Foreign trade policy relies heavily on self-certification, which makes compliance extremely important. Penal action may be initiated if an authorization holder violates license conditions, fails to fulfill export obligations, neglects payment demands, or submits false or inaccurate information. In serious cases, the regional authority may place the entity on the denied entity list, commonly known as DEL. Once included in the DEL, the firm is effectively blocked from obtaining licenses, authorizations, certificates, scrips, or various FTP benefits. Removal from the list is possible only after rectifying the default, fulfilling obligations, paying penalties, or submitting the required documentation. A key principle governing authorized imports is the actual user condition. Goods that are freely importable may generally be imported by anyone. However, when imports require authorization, only the actual user is permitted to import and utilize those goods. This prevents speculative trading and ensures that restricted goods are used only for their intended purpose. The condition remains mandatory unless specifically waived by the DGFT. From a policy perspective, this provision balances trade facilitation with regulatory control by ensuring that sensitive or restricted imports reach only genuine users rather than unauthorized intermediaries. The FTP contains special provisions for imports of samples, gifts, and passenger baggage. Trade samples are generally allowed without authorization, even when the underlying goods are restricted, subject to specified exceptions such as defense items, seeds, bees, and new drugs. Gifts imported through post or courier cannot generally seek customs clearance as gifts, except in limited cases such as Reiki and life-saving medicines. Passenger baggage rules permit import of bona fide personal effects, household goods, and certain trade-related items. However, restricted or STE-channelized goods continue to require proper authorization, even when brought through passenger baggage. To support industrial development and technological innovation, the FTP grants relaxed import rules for certain specialized categories. Goods previously exported for repair, testing, or upgradation may be re-imported without authorization. Contractors completing overseas projects can also bring back equipment used abroad, provided it was utilized for at least 1 year. Similarly, industrial users and research organizations may import prototypes and developmental samples without authorization after providing the required self-declaration. These provisions reduce compliance barriers and encourage innovation, modernization, and efficient project execution while maintaining necessary customs oversight and accountability. The FTP adopts a selective approach towards second-hand capital goods. Certain categories, such as air conditioners, diesel-generating sets, desktop computers, notified IT goods, and used IT assets moving from SEZs to the domestic tariff area, are classified as restricted and require authorization. On the other hand, most other second-hand capital goods are freely importable. Refurbished or reconditioned spares may also be imported freely if certified by a chartered engineer as possessing at least 80% residual life. This policy seeks to encourage productive industrial use while preventing indiscriminate import of obsolete technology and electronic waste. The treatment of second-hand goods other than capital goods depends largely on their intended purpose. Goods imported specifically for repair, refurbishment, reconditioning, or re-engineering generally enjoy liberal import treatment and may be imported without authorization, subject to prescribed conditions. However, all other second-hand goods are classified as restricted and require import authorization from the DGFT. The logic behind this distinction is straightforward. The government seeks to support industrial repair and circular economy initiatives while restricting unrestricted inflow of used goods that could adversely affect domestic industry, safety standards, or environmental objectives. As India focuses not only on trade promotion, but also on product quality and consumer protection, quality control orders, commonly known as QCOs, play a crucial role. These orders are generally issued by the Bureau of Indian Standards and ensure that products entering the Indian market meet prescribed safety, health, and environmental standards. As a general rule, manufacturing or importing notified goods without complying with applicable QCO requirements is not permitted. However, the FTP provides limited exemptions for specific export-oriented schemes, such as advance authorization, export-oriented units, and special economic zones. These exemptions are carefully controlled to ensure that non-compliant goods do not enter the domestic market. The FTP permits advance authorization holders to import certain inputs without mandatory QCO compliance, but only under strict safeguards. First, the imports must satisfy the pre-import condition. Second, the imported inputs must be utilized in manufacturing export products under the same authorization and ultimately exported through physical exports. Deemed exports do not qualify for this benefit. Another important restriction is that any unutilized imports can never be diverted into the domestic tariff area. Such goods must either be re-exported or destroyed under official supervision. If these conditions are violated, the authorization holder becomes liable for customs duty, interest, and specified composition fees. Even the exemption itself must be specifically endorsed on the authorized. Export-oriented units and special economic zones also receive QCO exemptions, but the underlying principle remains unchanged. Inputs imported without QCO compliance must be used exclusively for export production. For EOUs, an undertaking must be submitted to customs authorities and the development commissioner at the time of import. Similarly, SEZ units must provide the prescribed undertaking to the development commissioner. Most importantly, any diversion of such inputs or goods manufactured from them into the domestic tariff area is strictly prohibited. The exemption is available only when production is intended for physical exports, ensuring that the relaxation promotes exports without compromising domestic quality standards. The FTP recognizes sophisticated international trading models that do not always involve physical import into India. In a high-seas sale, goods destined for India may be sold while still in transit before customs clearance takes place. Merchanting trade goes a step further. Here, goods move directly from one foreign country to another, while an Indian intermediary manages the transaction without the goods ever entering India. Such transactions are generally permitted subject to RBI guidelines. However, merchanting trade is not allowed for goods covered under CITES relating to endangered species or goods classified under SCOMET. These restrictions ensure that trade facilitation does not compromise international obligations or security concerns. Modern export transactions often involve multiple parties, and the FTP formally recognizes such arrangements. A supporting manufacturer may produce goods on behalf of a merchant exporter or another authorized exporter. To ensure proper allocation of benefits, the names of both parties must appear on prescribed export documents. Similarly, third-party exports are also permitted under the FTP. In such cases, one exporter ships goods on behalf of another exporter. While the shipping bill must mention both the manufacturer and third-party exporter, documents such as invoices, export orders, bank realization certificates, and self-declaration forms must be maintained strictly in the name of the third-party exporter. Proper documentation is therefore critical in these arrangements. The FTP adopts a liberal approach towards exports of samples and promotional materials. Trade and technical samples of freely exportable goods may be exported without any quantitative limit. Such samples can even be carried through passenger baggage in appropriate cases. Gifts are also permitted, but subject to an annual limit of 5 lakh rupees during a licensing year. However, if the item itself is restricted under the ITCHS classification, authorization remains necessary even when the export takes the form of a gift. Passenger baggage exports are also permitted for bona fide personal effects, whether accompanying or unaccompanied, subject to specified timelines and regulatory conditions. The foreign trade policy contains special provisions that facilitate import specifically for subsequent export. Goods that are freely importable and freely exportable may generally be imported and exported in substantially the same form without authorization. Additionally, goods may be imported under customs bond and cleared for export against receipt of freely convertible foreign currency, even where the goods are otherwise restricted for import. Certain foreign origin goods that are free to import but restricted for export can also be imported and re-exported through bonded warehouses. A key compliance requirement is the currency matching rule, which generally requires exports to be realized in the same freely convertible foreign currency used for imports. The export cycle is considered complete only when export proceeds are successfully realized. Although export contracts may be denominated in Indian rupees or foreign currency, realization must generally occur in freely convertible foreign currency unless a specific exception applies. Failure to realize export proceeds within the period prescribed by the RBI can have serious consequences. The exporter may be required to surrender all benefits and incentives availed under the FTP and may also face penal action. Supporting exporters throughout this process are export promotion councils, which issue registration-cum-membership certificates, and export credit agencies such as EPCG and Exim Bank, which provide insurance, guarantees, and financial support. Let us conclude with two important compliance concepts. First, the registration-cum-membership certificate, or RCMC, issued by export promotion councils. This certificate is generally mandatory for obtaining authorizations and claiming benefits under the foreign trade policy. Second is the concept of self-certification of origin. To reduce compliance burdens for trusted exporters, manufacturer exporters who are also recognized status holders may self-certify the origin of their manufactured goods. This allows them to claim preferential benefits under various trade agreements such as FTAs, PTAs, CEPAs, and CECAs without relying on external certification agencies. However, this privilege is strictly limited to goods manufactured under their approved industrial authorizations.